Let's give it a whirl. Yeah. All right, let's get this party started. All right, here. Hello, hello, welcome. Voice is a bit under the weather today. I'm going to try to do Powell, but I don't know. We'll see. It starts in I think the data comes out right now, and then I think he starts talking in a couple minutes. 30 minutes, so about 20 minutes. A lot of times right before they start talking, the market moves and makes some moves in advance. We've already had kind of this reset point where we came down and everything was brought really low before this Fed meeting. And there's a lot of people who are following news, and they're following obviously the situation in Iran and Israel. But in addition to that, with GameStop, you got this whole situation with the offering and having that right around earnings. And it went from a 1.75 to like a 2.25 offering or something. And their Bitcoin news, and there's just all kinds of stuff. So the market really shifted over the weekend, I think, from this really negative, like war might be breaking out kind of news to, oh yeah, the Fed meeting and interest rates. And I don't think largely anybody is expecting anything for cuts right now. That would be a huge surprise. But I do think there may be some news about potential rate cuts going into August or end of the summer, August, September kind of area, maybe in that quarter, I think entering, Q3 or what have you. Yeah, maybe even closer to Q4, but we'll see. So I'm not really expecting anything particularly unique here today. Usually what the chart is already kind of doing is what the chart's going to do. So right now there's clearly been, some pretty sizable pullback. Certainly it's had some trouble advancing here. You could certainly see this as a double M that's maybe not been able to find its footing yet. This is actually very universally true for most stocks that I've looked at lately. It may seem like they're not the same if you're not really looking for it, but most stocks had this kind of genuine, kind of final push up that resulted in what I would think of as like a double M. And the reason that this works, this makes sense to me, albeit there are some caveats to it. But the reason that this makes sense is because typically with the double M, what you get is you get higher second motions. Like this is the general shape. It comes from Wyckoff, and I know that people don't all love Wyckoff theory, but the idea of this being a double M with kind of a double M on the bottom, or a double U on the bottom, if you want to look at it like that, this is really, in my opinion, all there is to fractals. People will say that they have some kind of an elaborate formula for it. There are certainly ways that fractals move a little differently on different stocks. But on the whole, wave schematics always break into the same fractal top to bottom. It's not really a mystery. And I don't personally like it when people tell me that they have some like fractal and they're using like some micro fractal from 2009 or you know what I mean, or something like that. It maybe wouldn't be that far. This is an exaggeration. But they're using some section from 2000 and like there was this guy, I don't even remember his name, and I wouldn't say his name if I did remember it, but he came on to that first Discord group I was hosting, and he said that, he had the answers, right? And it was this idea that, like, he wouldn't provide that, and what he did provide was extremely convoluted and difficult to follow. And I understand that with fractals, it's hard to, like, make that clear, but he basically was going out of his way to kind of show that he was the smartest guy in the room, that everybody was wrong, and that the master fractal that I had picked out was not actually the master fractal. And the thing is that he was picking a section that was clearly wrong. I mean, if you look at it now, there's no way to make it right. I mean, you can go back and look at what he was looking at, and it was obviously wrong. But it's interesting because at the same time, he was wrong, but he's like, he probably would have been able to figure a way to make it look like he was right because he was using like a cat ear, basically, which is interesting. So he's using this push up with a double top cat ear. He was basically saying we were like between the ears on AMC. I think it's interesting because like at the time you would have said like, hey, that's obviously not what happened. But I could go back and probably make an argument that he wasn't like 100% wrong because ultimately he was looking at this kind of like double M shape, and it did do that. It did have this kind of middle breakdown, and that was the S curve. So why am I mentioning this right now? Because everything in the market has been doing that, like as of late. I mentioned this setup here on AMC as a probable candidate. And I don't know if it's behind or if it's going to break out, but it has all the markings of like that double M. You have the initial drop in, there's an LSPY, and then there's an auto reaction that goes lower, which is typically bad unless you make a higher high and reverse it, which didn't happen. So at that point, you're in like the S-curve model, not the bottoming kind of model that you normally would want to see, at least not the way you normally want to see it, right? It could be that this S-curve is completed or it's a shallower S-curve. That's fine. But the idea there is that initial reaction and then the M, that's really no different than what we talk about here. Like it's basically the exact same form. It's just appearing in like a downward motion. So you're getting that initial kind of buy up here, and then there's this LSPY, this preliminary support as well. But there's an auto reaction, and then you're really just getting like the same thing, And the formation of that never really surprises me. And you can find that pretty much everywhere on different scales and I think it's very simple because it really just represents like a turnaround. So the reason the cat ears appear to us to be like that is because we're looking at it this way. If we were looking at it upside down, you would look at it upside down and say like, well, can you do the same thing in an upside down land? And the answer is yeah. I mean, that's the upside down version of it, right? So there's no real difference in the two. It's just that one's going one way, one's going the other. And then these make up parts of a wave. So naturally, like when you connect them together, you're going to end up with like a sine wave schematic. But the reason I bring it up is because a long time ago, I did do what I called like a master fractal in order to try to break up the parts of it into like maybe something that you could kind of track. I've later changed a lot of the way that I look at that, and I don't look at it like as rigidly anymore because I think that I've learned my lesson about that enough times that it's not really worth it. It's not really worth the time to do that. And you don't really get a good idea of wavelength and measurement by looking at that thing. Instead, you get really tied up in like pieces instead of... So yeah, I've had people say that, maybe I'm not the expert at fractals anymore or something. I'm like, that's fine. I don't really care. But it's mostly because, I just genuinely don't. It doesn't bother me. If they think someone else is better at it, that's fine. But a lot of it has to do with the fact that I just don't believe that it's as complicated as people make it out to be. And I've learned the hard way, I think, in my opinion, from my own experience, that it's just not really worth it. So when I got to this place where I was like starting to do wave analysis, what I realized is that this master fractal, which really was a development of the cat ears, and it's on the screen right now if you want to look at it. Really, this is just an iterative motion that's just kind of building out a range. And the whole point of the up-down motions here and why they're kind of shrinking is that you're getting that repetition of 1, 2, 3, 4 buy-ups, like 1, 2, 3, 4 with the retracements, and that generates on the whole like a nested sequence. So there's all kinds of different ways to kind of analyze the same thing, and I tried to break it into parts and suggest that somehow if you could map all these parts, you'd figure it out. That's partially true if you can map the parts correctly. Partially true because you can, in some ways, kind of figure it out. If you've got it right, you will get it right. You know what I mean? Like if you've got the timing right. The problem is with the wavelengths. So if you're saying this is 1 part, 2 part, yeah, then this would be the third. It could be correct. The problem is that there's fractal expansion. This could be part 1. This could be part 2, right? And so a wave could be making up a bigger wave. And that's why I don't use it as much as I use other things. When I'm kind of just looking at generalized reactions, I tend to look at iterations big to small as much as I can to try to ignore the micro junk. But I digress. Why did I say that I thought everything was kind of the same? It kind of is. If you look at the overall picture here, this would be like a topping motion. There's a weaker reaction here, and then it goes into like a basin that's clearly like a kind of a sign of weakness of sorts. Or at the very least, it would have to be some kind of a spring. And then you're doing this kind of motion. So for me, I'm like, yeah, that makes sense. This would be the first 2 M's. This is the second 2 M's. And again, you get this kind of higher elevated top action that separates itself usually by some kind of a midline or something. And then you get this secondary action. So when I look at this, I can see that, and I feel like, yeah, probably wise to consider that as a possibility. And interestingly, that's very similar to what I'm doing on AMC right now. So I think it's definitely a possibility that this is a kind of a widening, right, function. And you can see that a push up to 603 could make you think you're running. I'm going to move this over a little bit. The timing was off. But you can see why that would definitely look right, pushing up here. But it doesn't mean you're necessarily going to go over that ceiling either. That's just kind of a given. Like you'd have to break that. But on the whole, is it kind of meeting the expectations of some kind of a what I would call like a cat ear sequence? Yeah, you got the low dip in the middle. That's like the lower wave. But then the question mark is always at the end. So just like everything else we talk about, this M can break down. This is what I call like the foretop or like second cat ear, or it could potentially break out and over. And it's a little bit complicated because it starts looking like it meshes together, but that's the nature of fractals, right? If you're going to use fractals. And a breakdown would look a lot more like violent, and you'd have certain things that happen up here that are particularly bad. I don't see that. I don't see it on SPY as being particularly bad right now, but I do see this as a potential weakness right here. So one thing that's curious to me is like we did not push all the way up. We did come above this top, which could be seen as distribution, I suppose. And it did push low after that. But then what remains isn't particularly scary looking. Like it never on the bigger picture made a higher high. So there's certainly problems. You get into a little bit of guesswork when it comes to this stuff, but on the whole, I would suggest that, yeah, it's doing this kind of repetitive motion of M shapes. So you've got a wave up, a second push here, a second wave up. And naturally, then you're going to be kind of concerned that, well, would it then come back down Friday or something. It could. I mean, you can see the motion right there. It's very possible. So if you're going to simplify it, get rid of the extra clutter, this is an easy way to look at it. And then it's really easy to tell, like, that's the creek that was jumped. It was checked here, checked again, actually pushed above it and pushed below it, which is really interesting. It may be a really adequate check, I'm not sure. But that would be the first stop, right? And then your second stop would probably be back down to the bottom, whatever the low is going to be. So naturally, like, you just look at the creeks and you can see, well, there's a gap down here. That's an easy one, right? Does that make sense with the direction that this is moving? Yes. So does it mean that you have to hit it now? Well, no, not necessarily. But we saw the same thing on AMC, really. Like, there was this kind of wave structure that was pointing us down all week. And I see the same thing on SPY. And I see the same thing on, and to some degree on GME as well, even though it already came low. Remember, last time that GME dropped like this, it ran ahead of the market. I don't know if you guys recall that particularly, but I remember it being kind of interesting because once it dropped, if you go to April, here's April 2nd right here, there was another drop, but it never goes low again. And you might say, well, tariffs wouldn't have that big of an impact. It's still an import-export, you know, if they have overseas business, so it could have an impact on them. But the point is that this was already kind of advancing about a day ahead of everything else. And I thought that was pretty interesting. When this dropped, this has a bounce and then a lower low. This has had a bounce. It hasn't had a lower low yet. It's just kind of a build out, high volume. It's not impossible that it breaks down again, but I want you to notice the same pattern is here. And that's what I'm trying to make a point of. It's like, I know we're starting the stream pretty close to this FOMC meeting, but this is really identical, you know, in so many ways. This is the middle. So here you can see the walk-in here, right there along the walk-in is kind of right around, I think it's 22, I was going to say 2285, and I think that might be right. But you can see the reaction, the second top. Then you can see this kind of foretop, right? And now it's kind of made a basin move, and it may be trying to advance. It's going into what looks to be almost like a cross-up. It dumped that first trend line. And though this could have been, potentially could have been a wedge for sure. I even thought if it was a wedge, it probably comes back to 2230. That's still a possibility. It's not impossible. It does that. There's still a drop here that could happen pretty low. So keep 2230 on your chart. It did already advance again. It tried to go back and it made a new high here. So interestingly, if you widen it out and you don't use, I'm going to get rid of this. This is old. If you don't use that first bottom here and you use kind of like the second wider bottom, not use that first trend, it's possible that this is either A, still in a wedge, or B, and so it's not using the first hit. Or B, it's actually rebounded. It did use the first hit, but it's already come back in. You can see it would have gained support again, potentially, right there. And then you also have this second parallel now, and if you take that one up, it kind of goes through the middle back here a bit differently, as you can tell from the original starting points, those drop ledges, especially this hook. That's just a trajectory, right? It's like directional movement. It certainly matches. It's not that different, so I mean, take it with a grain of salt. Draw the trend however you want to draw it. But my point being is that this is it's kind of interesting because if you go back up and you look at the really the strongest creek here, not that fake out move at the end, but the stronger creek here is actually quite nice, and it's really right above us on GameStop. So I'm looking at all these and I'm like, okay, I can see how if it made another leg down here, it could be a pretty significant drop. And there may be some spooky action, you know, in the short term. Like this, for example, dropping down to like 280s or 290s for sure. A lot of that goes back to that May 22nd date back here. It's more like June the 6th. Certainly it's in that wave where it could do that. It's also in the wave M shape where if it doesn't go low and it reverses, then it's going to cross up pretty strong. And you're probably going to get a double M cross to the upside like so. So we're really at that inflection point. We're at a point where it's going to make a decision. Could it be a little bit of both, where it has like a nasty drop and then rises? Sure. I'm not too concerned about that. Whatever comes of it after the move comes after the move. But I'm looking at specifically that trend, the overall picture being kind of a double M, and wondering if there's going to be that breakout crossover or if it's going to just kind of drop and hook. And by the way, if you're worried about that, you don't know what to do, just remember like where those reactions would go to, like a drop and hook here would go back to, I'm kind of screwing with these charts the wrong way. A drop and hook would probably go down pretty low, it may go to that gap fill even lower. A hook would likely stop advancing again at that previous support level, in which case you're stuck. You could still have a cross later, like maybe next week or even like the week after that. But pretty much from there, it's like, meh, it's a little bit far out. We'd have to see where all the indicators are. You could still go down. Like, there's just a lot of big questions there of like, well, what does this turn into? It could turn into a wedge, yada, yada, yada. And I don't think it's wrong to speculate, but I think that this is a bit of a question mark, right? It's like, that's a big difference from breaking out here and heading up. So the better practice, in my opinion, if you were trading something like this, if you're trading downside, it'd be just to look at the overall trend to see where the breakdown would be. And that's as simple as you need to make it. And then same for the upside. So you would take this, and if it dropped beneath 597, you could trade it down. If it broke above this top, I guess as the crow flies, it'd be now around 601. Then you could trade the upside. With the caveat that, of course, there could be fake outs. I think that that's reasonable. I think it makes sense. And at the end of the day, I couldn't really tell you for sure. I've been speculating that this is going to have another push-up. It didn't really do that, did it? It kind of just popped up, stopped short at 604, hasn't made a second push-up to 610s. And the market on the whole doesn't necessarily need to. The last time that we went through this in the similar region was back here. And we sort of built out over the top, and there was a 1, 2, 3, 4. And it just didn't advance. And then it drops pretty hard, And I'd be willing to bet this was around an FOMC. This looks like a Wednesday, the 18th. So you never know. These setups are they are really news dependent sometimes, but I think that it's a bit wishy-washy, as a wave goes. I could definitely make an argument that that's a wave 4. This is a 1, 2, 3, 4, potentially, with a 5 incoming, but that's a micro version of a 5 wave, as well, because that would be, again, the third one would be here, and then this would be 5. So again, mixed signals, perhaps, and this really only gets you up to the top anyways, if you use that. So do I think Elliott wave people have it down pat and would know exactly where it's going to go next? Maybe, I don't know. This looks like it should go really, really high if this is a 1, 2, 3. But then again, if it's a 3, 4, this 4 is like completely wrong. So I'm kind of lost in the Elliott wave stuff there. If it's not super simple, I usually can't track it. It's not my expertise. So I do expect the Fed to not be completely game-changing today. It would be pretty crazy if they just suddenly cut rates. But I've been looking at the charts for a good while now. And for about the last 6 months or so, everything is really boiled down to August, which is just after summer. August is still in summer if you're in the South, for sure. Some places it's not as bad. So I'm saying after summer, but I'm also thinking summer is always like later than I think it is in my brain. I always think about it in terms of like being a kid at school. You go back to school sometimes in certain places in August, but August is still summer. So anyways, August going in September really is like the high point for a lot of stocks, or it's certainly a strong pivot point. So if they're not high, they may be going down for a spring at that time. So with July news around the corner, if FOMC news is good, I do kind of expect it to flip-flop, perhaps. And maybe July news is not as good, so on and so forth. Maybe the Fed news today being kind of consistent would just sort of let the market breathe a little and just kind of finish it off. And then if they do announce, hey, we're going to do something in the summer, I'm not going to bat an eye at it. I'm just going to say, if they say, hey, we're looking at maybe August, September, and I don't think they've announced anything yet. They've been saying they were going to do a couple this year. Nothing's happened so far. So, I mean, it's going to be pushed to the end of the year if they wait. We'll see. Okay? All right. So, I was asked to do LCID Lucid. So, I'm going to do that before Powell starts speaking in about 5 minutes. I've been looking at XRP quite a bit. Same deal. It's like it's still in that M shape. Everything to me just looks so similar. It's kind of strange. And it really does look like it's on the cusp of either a breakdown and just kind of a finishing breakdown here with a reversal, or just like a pop and then potentially a drop. Because to me, this looks like a double ear right here. This would be like a middle. And then you'd have like a second ear here. And that makes a lot of sense to me. But this is kind of what I'm seeing across the board. Weirdly similar to AMC as well, this one, XRP. What's my prediction? August. For GME. Same deal. I think it's going to pump. I don't know exactly how it's going to happen at that time, but probably around the 6th to the 20th, and then by September 6th, so about a month of a window. It's a big window, but it goes from August 6th to September 6th. I think it's very likely going to have a big move there. I don't necessarily think it's going to go to all-time highs at that time, which may be kind of different from some folks. You may think it will. It's going to largely depend on right now. I'll be honest, because if we can get above 26 right now without making a lower low on GME, there's a good chance if we can get back over 26 here, I'm going to look at the macro chart if that happens, and if it breaks over 26 again, and it's not doing some kind of a mass distribution, right? It's not doing just kind of a second topping motion here. There's a good chance that breakout yields just higher highs until August, and then it breaks high. If not, then yeah, we've talked about it before. I'm in agreement with some others even on it that have said 17s. I think it's very possible you get there by about that time, and then late August to September, maybe you break out. But this is complicated because of the nature of what happened here and that offering. I do think you just have to take the chart as it is. Right now, it broke down. There's a huge gap above. There's a decent chance if it runs up pretty hard, it can get back to pretty easily get back to this marker. I've got it earlier than later, but about 32. And then we'd have to wait and see. That's where you really have to sort of see that hold strong and break out and up, or you're going to likely just head down to 17, because that would just be a distributive action. So, again, kind of running out of time here. So I'm going to try to do LCID. Let me go ahead and make sure that this YouTube thing is set up so that I can hear Powell talk when he starts talking. Oh, geez. That was loud. Why do they do that, man? I have to just make sure that's on the dual audio thing. So internal capture as well as external capture. So let me double check it and make sure it's working. All right, it's working. So that's their Fed channel. All right, let's talk about Lucid here. This is definitely a fan favorite for a lot of people who are in the meme stock stuff. To me, this looks like he's coming on. He looks like everything they've talked about.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I'll have more to say about monetary policy after briefly reviewing economic developments. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP as we call them, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.4% this year and 1.6% next year, somewhat slower than projected in March. In the labor market, conditions have remained solid. Payroll job gains averaged 135,000 per month over the past 3 months. The unemployment rate, at 4.2%, remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.5% at the end of this year and next, a bit higher than projected in March. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.3% over the 12 months ending in May, and that, excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 3%, somewhat higher than projected in March. The median inflation projection falls to 2.4% in 2026 and 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to trade, immigration, fiscal, and regulatory policies continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year, the same as projected in March. The median projection declines to 3.6% at the end of next year and to 3.4% at the end of 2027, a little higher than the March projection. These individual forecasts are always subject to uncertainty, and as I've noted, uncertainty is unusually elevated. And of course, these projections are not a committee plan or decision. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on issues related to assessing the risks and uncertainties that are relevant for monetary policy and the potential implications for policy strategy and communications. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference that we held last month. We are open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up any modifications to our statement on longer-run goals and monetary policy strategy by late summer. After that, we will consider enhancements to our suite of communications tools, including the SEP. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Colby. Thank you. Colby Smith with the New York Times. To what extent has the more limited impact from tariffs at this stage on inflation changed your view on what the ultimate economic fallout will be from these policies and the timing of when they will materialize in the data?
So we've had 3 months of favorable inflation readings since the high readings of January and February, and that's, of course, highly welcome news. Part of that just is that services, core services, both housing services and non-housing services, have really been grinding down toward levels that are consistent with 2% inflation. So that's the good news. We've had goods inflation just moving up a bit, and of course we expect, as you point out, we do expect to see more of that over the course of the summer. It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months. We do also see price increases in some of the relevant categories like personal computers and audiovisual equipment and things like that that are attributable to tariff increases. In addition, we look at surveys of businesses, and there are many of those, and you do see a range of things, but many companies do expect to put all or some or all of the effective tariffs through to the next person in the chain, and ultimately to the consumer. Today, the amount of the amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more. And we think our policy stance is in a good place where we're well positioned to react to incoming developments.
So in terms of how we should interpret the rate cuts penciled into the SEP, is this reflecting that there's this expectation that underlying inflation will just stay well enough contained that allows the committee to eventually move ahead with those cuts? Or is it about, responding to a deterioration in economic activity, let's say? I mean, how should we make sense of the forecast?
So if you look at the forecast, you will see that people do generally expect inflation to move up and then to come back down. But we can't just assume that. Of course, we don't know that. And, our job is to make sure, one of our jobs is to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that, again, that will depend on the size of the effects, how long it takes for them to come in, and ultimately on keeping inflation expectations anchored.
Hi, and thanks, Chair Powell. Howard Schneider with Reuters. If you look at the rate path starting in December to today and adjust it over the full time horizon you've got there, you've taken about a quarter point per year out of your projected path, and you end at a higher rate at end 2027 than you would have in the prior forecast. Is that a result of a sense that tariffs will lead to more persistent inflation? Is it a result of reassessments of where your short-term neutral rate is? Why are you on a slower path now?
So I would focus most on the nearer term. As you get out to the later years, it's hard for anybody to know where the economy is going. You didn't see people moving their longer term, estimate of the neutral rate, for example, at this meeting. So and those things are probably slow moving. So I think if you look at what's happening here since March, this is since March, right? You see a little slower growth, just a tiny tick up, a 1/10 tick up in unemployment, and you see inflation moving up 0.3. And by the way, it was a similar move from the December SEP to the March. So that's what you see. You see the effects of tariffs. I think we learned in April, after the March meeting, that substantially higher tariffs were likely. And then since then, the estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time. And what you see is an accumulation of individual assessments.
You say in the statement that risks have diminished on that front, but the July 9th, drop dead date for all the Liberation Day tariffs is still out there and unresolved. You've got now exchange of missiles between two Middle East adversaries with a possible U.S. involvement. How can you justify saying that risks have diminished?
So what we said was that uncertainty uncertainty about the economic outlook has diminished but remains elevated. Many surveys say that. They do. So, and that's actually a line from the Teal book, which you can see in 5 years. Remember to check that.
Maybe the war will be over.
No, but if you think about it, tariff uncertainty really peaked in April, and since then has come down. And that's really what that's just acknowledging. It's diminished, but still elevated. That it's uncertainty. So I think that's an accurate statement.
Thank you. Chris Rugaber at Associated Press. There is an argument out there in favor of cutting rates more immediately. Inflation has continued to cool and is back to roughly 2% despite the tariffs. And I guess I also wanted to ask about cracks in the job market with gross hiring slowing, concentrated in just a few industries. We've seen some housing data, including this morning, that has been pretty weak. Do you see any concerns that the economy is weakening and that is a reason to cut rates going forward?
So we do of course monitor all those things. I think if you look at the overall picture, what you're seeing is 4.2% unemployment and an economy that's growing at a rate hard to know given the unusual flows in the first quarter, but it appears to be 1.5%, 2%, maybe a little better than that. Sentiment has come up off of its very low levels. It's still depressed. So, you can point to things. The housing market is a longer run problem and also a short run problem. I don't think it's indicative of, basically the situation is we have a longer run shortage of housing, and we also have high rates right now. I think the best thing we can do for the housing market is to restore price stability in a sustainable way and create a strong labor market, and that's the best thing we can do for the housing market. You asked about the job market. Again, look at labor force participation, look at wages, look at job creation. They're all at healthy levels now. I would say you can see perhaps a very, very slow continued cooling, but nothing that's troubling at this time. But we watch it very, very carefully. So overall, again, the current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments, and for now, and we'll be watching the data carefully.
Well, just quickly on, given that there are concerns inflation will rise, but there is the alternate scenario that tariffs would create demand destruction and slow growth sufficiently, and that would perhaps keep a bit of a lid on inflation. Do you see odds of that scenario? What kind of odds do you see of that scenario coming true, and how many months of cool inflation would you need to see before concluding that maybe that lower inflation scenario is taking place?
So this is very much the conversation we had today and yesterday. There are many, many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the levels we think, and where the labor market does or doesn't soften. And I think what you see people doing is looking ahead at a time of very high uncertainty and writing down what they think the most likely case is. No one holds these rate paths with a great deal of conviction, and everyone would agree that they're all going to be data dependent, and that you can make a case for any of the rate paths, I think, that you see in the SEP. And we do this once a quarter. It's a hard thing to do particularly at this time, but it does reflect. If you see somebody writing down a rate path that involves cuts, that's them saying, yes, I think we will get to a place, more likely than not, where cuts will be appropriate. And it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
Thank you. Mr. Chair, I wonder if you could describe for us some of those scenarios. How do you get to a place? I'm noticing that the uncertainty levels in your forecast are very high. How do you get to a place where you have the confidence in the outlook for, say, inflation and or growth or the unemployment rate? How many months does it take, and what do you want to see in the data to get to that level of confidence to actually reduce rates off the restrictive level?
So it's very, very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing the kind of labor market that we have and reasonably decent growth and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn more. And in particular, we feel like we're going to learn a great deal more over the summer on tariffs. We hadn't expected them to show up much by now, and they haven't. And we will see to the extent to which they do over coming months. And I think that's going to inform our thinking, for one thing. In addition, we'll see how the labor market progresses. So at some point it will become clear. I can't tell you exactly when that will be. And meanwhile, we'll be watching the labor market very carefully for signs of weakness and strength, and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think we don't yet know with any confidence where they will settle out. We have an estimate, and I think all estimates are now pretty close together, but it's again highly uncertain.
When you say estimate of the impact of tariffs on the core PCE, is that what it is? And could you share that?
What you start with is what's the effective tariff rate overall, and people are managing to that. But the pass-through of tariffs to consumer price inflation is a whole process that's very uncertain. As you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer. And each one of those is going to be trying not to be the one to pay for the tariff. But together, they will all pay for it together, or maybe one party will pay it all. But that process is very hard to predict. And we haven't been through a situation like this. And I think we have to be humble about ability to forecast it. So that's why we need to see some actual data to make better decisions. We'd like to get some more data. And again, in the meantime, we can do that because the economy remains in solid condition.
Nick Tamarosa of the Wall Street Journal. Chair Powell, I guess I'm wondering if you could explain a little bit more the divergence we see in the dot plot, particularly around the 2025 rate projections. I realize this is, you have one group of officials that are putting down no cuts, another that are putting down more than one. And again, recognizing that could be difficult to summarize, but is it a matter of people having a different outlook or a different reaction function, a different commitment to defending against another inflation mistake? How did that play out over the last 2 days?
So you're right. This is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for today's decision and broad agreement that our policy stance does leave us in a good place. But I would point to two factors, and you mentioned them. The first is just that parties have a diversity of forecasts, and they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down, more cuts. But remember, as we see more data, we're going to learn more about where inflation is headed, and that means when it is time to look at resuming our normalization process, the differences you see should be smaller because we'll have seen actual data. Right now, it's just a forecast in a very foggy time. So that's the first part, is forecast. Secondly, people can look at the same data and they can evaluate the risks differently, as you know. And that includes, the risk of higher inflation, the risk that it'll be more persistent, the risk that the labor market will weaken. People are going to have different assessments of that risk. So you put that in there too. So those are the two ways that the two things I think that drive these things. Remember though, as I mentioned earlier, with uncertainty as elevated as it is, no one holds these rate paths with a lot of conviction. So that's really where it is. It's a function of those things. And I think as the data come in, you should see those differences diminish.
If I could follow up, you've said the policy is in a good place and that it's modestly restrictive. Given all the uncertainty you just talked about, tariff levels, uncertainty around the pass-through, is it price increases versus margin compression, some of the softness that Chris talked about in labor and housing, why wouldn't it be better to have rates at a more neutral setting as the economy heads into this period of very high uncertainty?
So if you just look backward at the data, that's what you would say, but that's not. We have to be forward-looking, and the thing that every forecaster, every outside forecaster, and the Fed is saying is that we expect a meaningful amount of inflation to arrive in coming months, and we have to take that into account. So I think a backward-looking look would lead you to a neutral stance, but we can't. We have to look at that, and because the economy is still solid, we can take the time to actually see what's going to happen. There's a range of possibilities on how large the inflation effects and the other effects are going to be. So we'll make smarter and better decisions if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass-through of inflation and what's going to be the effects on spending and on hiring and all those things.
Mr. McKee.
Michael McKee from Bloomberg Radio and Television. Your friend down at 1600 Pennsylvania Avenue continues to lob insults in your direction, and I'm wondering, given now that the Supreme Court has maybe carved out the Fed from some of the legal implications of that, whether this is just noise that the markets and everybody should ignore until your term is up, or whether you worry that it could lead to more pressure on confidence on Wall Street, on consumers, about the outlook for the economy.
Look, from my standpoint, it's not complicated. What everyone on the FOMC wants is a good, solid American economy with a strong labor market and price stability. That's what we want. We think our policy is well positioned right now to deliver that and to be able to respond in a timely way as the data lead us around. The economy's been resilient, and part of that is our stance. And again, we think we're in a good place on that to respond to significant economic developments. That's what matters. That is what matters to us. Pretty much that's all that matters to us.
I need to ask, assuming you are not reappointed, would you stay on as governor when your term as chair ends?
I'm not thinking about that. I'm thinking about this.
Andrew.
Thanks, Mr. Chairman. I guess with workplace raids increasing, picking up significantly, what kind of effect would that have on the labor market in
Sorry,
the short
with
term?
what picking up?
Workplace raids.
So you're asking immigration.
Yeah.
You know, I wouldn't want to speculate. One way to get at that from an economic standpoint, we of course don't comment on immigration policy. It's not ours to make or comment on. But what you see is an unemployment rate that has been really solid and at a low level, not really increasing. It's been in a good range and well within the range of mainstream estimates of maximum employment. And that means, like, part of that is that labor demand and labor supply are kind of moving down at the same rate. Labor demand is softening. You see that in job creation, but it's still kind of at a healthy level. And labor supply is diminishing because the immigration numbers that we see are much lower than they were. So those two factors, supply and demand, that's what has kept the unemployment rate in a reasonably stable place.
Okay, thanks. The other thing I wanted to follow up on is if you could elaborate on the potential changes to the SEP that you suggested were part of the framework review, I think.
So the framework review really has two tracks, right? The first track is our policy framework that is reflected in the consensus statement. And we've said that we would finish that and announce it by the end of the summer. So we're well along in that process. We've had the meetings that we need to have, and we're now going to be going into, into discussions about, specific changes to language. So that's the framework part of it. The second part of it is our communications tools and practices. Pardon me. And that part comes next. Okay, that's what we're going to do in the meetings this fall. Actually, what we did at this meeting, though, is we sort of prepared the ground for that. We had a meeting where we talked at a high level about a number of ideas. The SEP is part of it. Many other ideas. It's sort of, how do we think our communications can be improved? There are a number of ideas. People offered a really, it was a great conversation, number of ideas, but we're going to look at those with staff briefing and a lot of thought in the fall. And I would say when it comes to changing communications, I would only support things really that only implement things that have very broad support. And also you want to be really careful because I think our communications are pretty well received. They're not broken. So more is not necessarily better, but better is better. So we're going to be looking at ways to do things that will improve the clarity of what we do for the benefit of the public.
Thanks, Chair Powell. Kelly O'Grady, CBS News. You're famously known as the guy that makes decision based on data instead of speculation. You've said today the inflation data is in a good place. We don't know how tariffs are going to impact prices going forward. That's uncertain. But I've got to go back to the last time that you cut rates in December, and there was still the what if of tariffs. So what made you feel comfortable cutting then when inflation was higher than where it is today, and you didn't cut today?
Well, the forecast for inflation in December was 2.5. Core PCE for 2025, the forecast was 2.5%, which is a good inflation forecast. I think what we've learned is that, and this was long before we had any idea of what the actual policies would be, we've learned that the tariffs are going to be substantially larger than forecasters generally thought. And we don't, our forecasts are generally not particularly different from those of other, well-resourced forecasting operations. So what we learned, and particularly in April, was that very substantially larger tariffs were coming, and that would mean higher inflation. That's what happened. And so you saw 2.5% forecast in December, you saw 2.8% in March, and you see 3.1% now. So it's 0.6 higher inflation for 2025, and that's a big part of the change, and that's due to the effects of the tariffs that are, we don't know where they're going to land, but it's pretty apparent they're going to land higher than outside forecasters were really guessing at the end of last year.
My follow-up to that, I think consumers, right, we're looking for relief on rates when it comes to mortgages, car loans. Small businesses want to take out more manageable loans. When you look at the cumulative inflation over the past 5 years, prices have risen over 20%. It's been a rough road. So what is the tipping point then for the wait and see approach in terms of how much it's going to help versus when it hurts the American consumer?
Well, I mean, we're trying to restore price. Best thing we can do for the public that we serve is restore price stability. If we can, and we will, restore price stability, meaning 2% inflation on a durable, sustainable basis, that, and also maximum employment. If we restore those things, that's the best thing, and that is our goal. The best thing we can do for the American people, for households and businesses, that is the ultimate thing that we can deliver. And they can make their decisions without having to think about inflation all the time. So in the meantime, we have to keep rates high to get inflation all the way down. They're not very high, let's be honest. I would say policy is modestly or moderately, probably modestly now restrictive. If you look at the economy, it's not performing as though it were performing under very strict monetary policy, very restrictive monetary policy. So I would say probably modestly restrictive. And so what it will take is confidence that inflation is coming down. Now, I would say without tariffs, that confidence would be building, because if you see what's happening with non-housing services and housing services, which are the other two big pieces other than goods, those are coming down really nicely now. So I think we have to learn a little more about tariffs. I don't know what the right way for us to react will be. I think it's hard to know with any confidence how we should react until we see really the size of the effects, and then we can start to make a better judgment. So that's what we're doing, and I think we can take the time to do that because unemployment is 4.2%. Wages are moving up. Real wages are moving up at a healthy clip now. And inflation is 2.3% headline inflation over a 12-month basis. So it's a good economy and a solid economy with decent growth.
Thank you, Chair Powell. So you're saying that uncertainty has come down, the economy is moving at a solid pace, inflation has come down over the past 3 months. And this is all moving in the right direction. So are you indicating here that Americans should expect some sort of economic pain in the second half of the year?
I'm not saying that at all. From our standpoint, what I can say is that the U.S. economy is in solid shape. Inflation has come down. The unemployment rate remains at 4.2%. As I mentioned, real wages are moving up. It's a good job creation is at a healthy level. Unemployment, again, as I said, low. Labor force participation in a good place. So. And what we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that. Every forecaster you can name who is a professional forecaster with adequate resources and forecasts for a living is forecasting a pretty significant, everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs, because someone has to pay for the tariffs, and it will be someone in that chain that I mentioned between the manufacturer, the exporter, the importer, the retailer, ultimately somebody putting it into a good of some kind, or just the consumer buying it. And all through that chain, people will be trying not to be the ones who pick up the cost, but ultimately the cost of the tariff has to be paid, and some of it will fall on the end consumer. We know that because that's what businesses say, that's what the data say from past. So we know that's coming, and we just want to see a little bit of that before we make judgments prematurely.
And follow up on that. So you spent years though talking about how you're data dependent, and be a little more direct on this. Now you're making decisions looking forward. Doesn't the data you're seeing today indicate there should be a rate cut?
No, I mean, your monetary policy has to be forward-looking. That is elementary. You've got to be looking. I always talk about the incoming data, the evolving outlook, and the balance of risks. We say that over and over and over again, right? So it's always forward-looking. If at the very beginning of the pandemic, we cut rates to zero immediately. Nothing had happened. We just knew that it was going to be really bad, right? So we took very aggressive forward-looking because we knew things were going to be unusually difficult. So, of course, this is something we sort of know is coming. We just don't know the size of it. And again, the economy seems to be in solid shape. So the labor market's not crying out for a rate cut. Businesses, in a bit of shock after April 2, but you see business sentiment, you talk to business people now, there's a very different feeling now that people are working their way through this, and they understand how they're going to go, and it feels much more positive and constructive than it did 3 months ago, let's say. So again, we think that our current stance of monetary policy is in a good place.
Thank you. Amara Mokwe with Bloomberg. Chair Powell, in February, you told Congress that the Fed is, quote, overworked, maybe not overstaffed. Then in a memo to staff in May announcing a deferred resignation program at the Fed, you said you wanted to ensure that the Fed was, quote, right-sized. Those two statements appear to be at odds with one another. Could you explain what changed in the roughly 3 months between those statements that made you decide that staff levels at the Fed should decline?
I don't see them at all as intention. You know, so I was asked, is the Fed overstaffed? And I said no. And I sort of said as a pun, overworked but not overstaffed. People do work extremely hard at the Fed, and I know they work hard at Bloomberg too. So, but we do. We work hard. But I would say this. So we are careful stewards of public resources, and sometimes you need to show that. So there have been several times in our history, modern history, where the Fed has said, you know what, we're going to do a buyout. We're going to show the public, we're going to demonstrate that we are good stewards of public resources. So we thought, and I thought, that this is a time when we can, we grow at about, our headcount has grown at about 1% a year. So over the course of a couple of years, we're doing a careful scrub of the board and all the reserve banks, and we're going to find 10% of employees who can do something else, where we can streamline our operations, and we think we can get there in a year, in a couple of years. We think we can do that, and we think this is without taking risk to carrying out our critical missions. So this is something you do very carefully, thoughtfully, and you do it again respecting that we have critical missions to carry out. I've had experience, a lot of experience in my prior careers, with headcount reductions and things like that, and this is how you do it professionally. You do it carefully, thoughtfully, with a lot of planning, and you do it over a period of time. And I think the Fed will be fine. I think no one will notice any decline in our ability to carry out our missions, and I think it's just us wanting to demonstrate to the public that we are actually good stewards of their resources. We're effectively wiping out 10 years of headcount growth with this. So, I mean, we wanted to show that, that we're good stewards.
How is progress on reducing headcount going so far? Are you on track to meet the goal?
We're just at the very beginning. As you know, we're doing a buyout program. We're gonna hit that goal. I think many organizations find that they can do this. You don't want to do it every year or anything, but you can do it at intervals, and you wind up not interfering with your ability to perform your jobs.
Chair Powell, Claire Jones from the Financial Times. As you're no doubt aware, the Senate Finance Committee has tabled its version of the reconciliation bill this week, and I was wondering if you could tell me a little bit about the tenor of the debate at the FOMC over the past few days on fiscal policy and the degree to which that influenced people's projections for 2026 and beyond. Thank you.
Yeah, so, we don't sit around and debate or really discuss. We take fiscal policy as fully exogenous, and so we actually, really didn't talk about the bill or the contents of it. It's still evolving. When it gets closer, remember also we have a very, very large economy, and that the effects will be at the margin, I expect that they may already be in, but they will be in by the next meeting. We'll make an estimate, but it's not a major thing. It's nothing that we discuss. It may have been mentioned a couple of times, but as something that's coming in. But I think the outcome is, we don't know the outcome yet there, so hard to be real specific.
Neil.
Thanks, Chair Powell. Neil Irwin with Axios. There have been some cutbacks in economic statistics collection in the last few weeks, and worries that long-running problems around funding and response rates may be getting worse. How much is this concern on your radar? How much confidence do you have that the gauges you're watching to assess the economy are reliable right now?
Two things. One, the data we get right now, we can do our jobs. I'm not concerned that we can't do our jobs. That's not the point. The point really is that we are starting to see, layoffs and important gatherers of data are saying that they're having to cut back on the size of their surveys. That's going to lead to more volatility in the surveys. I think we should take a step back and, from our standpoint, and I think the standpoint of businesses and governments and everyone, having really good data on the state of the economy at any given time is a huge public good. It helps, it not just doesn't help the Fed, it helps the government, it helps Congress, it helps the executive branch. More importantly, really, it helps businesses. They need to know what's going on in the economy. The United States has been a leader for many, many years in this whole project of measuring and understanding what's happening in our very large and dynamic economy. And I hate to see us cutting back on that, because it is a real benefit to the general public that people in all kinds of jobs have the best possible understanding of what's happening in the economy and hence what's likely to happen. It's very hard to measure what's going on in the U.S. economy. If you read, there was a book called, it's really remarkable how many things you need to understand to estimate U.S. GDP. Very, very difficult, and it's so important that we get it right. I just would say it's not a place I would want to keep investing in that, for the good of the general public.
Victoria. Hi, Victoria Guida with Politico. So you're conducting this monetary policy strategy framework review, but next year we're supposed to have a new Fed chair, and I'm wondering if that affects at all the way that you're approaching this. How do you ensure that this framework will actually be durable?
The framework document goes back to 2012, and it's the committee's document. It's not like we're going to invent a brand new way to do things. It's been an evolving document, so it shouldn't depend on who the chair is at all. It should depend on what's happening in the economy and what the
Alrighty. Well, that was good enough. Enough of that. I was asked to look at LCID, and I did an analysis on that. I'm not going to go back and explain it all. I think it was pretty well explained on the chart. I'll share that in the Discord in a bit. I'll focus more on SPY and some of our key tickers here. So I've been talking about this breakout, and I said, I think AMC's got a potential here for a near 10% move. And I'm not being sarcastic or over the top when I say that. I've been talking about it up on the Discord, just saying, yeah, from where we were when I first mentioned it, it was about the same spot. It was a little bit above 3, maybe 310. You're really looking at a possible 8 to 10% move pretty easily. These are things that actually make a lot of sense if you look at the waveform here, and I talked about that before. This is basically like a big S curve right here to a downside, and then if you generally look at, it's hard to tell based on the way I did this, but if you look at like bottom to middle, top to middle, let me split the difference here. You can see this is building out. It's looking more and more like next week. I hate that it kind of kicks the can down the road like that, but I can't really control those things, and ultimately, like, upside tends to be faster. So what I would suggest is that could be representative of like another middle. Just like this is like the center mark, this could actually be representative of like a center mark. And it looks like whatever is going to happen down and probably be like a termination point is going to be over here. So this is a larger wave structure, very likely going to be between the 26th and the 30th. And I don't think it makes a lot of sense after that point going into the 8th that you're going to have a lot of huge change. But it's worth noting that like that's probably a really important final moment, regardless. One of the theories that I've been kind of spinning around on these plates is that we might be coming back down to the April, that April price target. And I'm starting to see it as a very strong possibility. There was a lot of, not because I guess we're back to where we were, that's not really the case, but really just the way it's set up. There's a lot of, let's just say, lack of retesting on that April drop. When you have a big market event and there's a huge amount of volume, no matter if it's up or down, if it's off of a gap or not a gap, if it's off of a cliff or a sudden run up or a creek break, it really makes very little difference to me. Anytime there's kind of a significant volume move, especially with news that's easy to tell, you should always pay attention, and I always try to pay attention to the level that it sort of left from. And for SPY and all these others, it's interesting because it's not come back to those levels in a way that I would say is like super meaningful. And it's very interesting that there's also this kind of a correlation to the rebound that happened, remember, and what happened before. This is really important because we had talked about this previously, and I don't know if I put enough emphasis on it at this point, but there's a really strong connection to the way we moved out of this bottom down here and how we moved out of this bottom down here. Like, they're basically one-to-one. They don't look like it maybe immediately, but if you go backwards and you look at the particulars that were checked on the way up during this first run-up, which really began in April of 2024, and you look at what happened during this run-up, what levels were checked, it's essentially like one-to-one. So it's sort of like a second chance move. This whole move right here is essentially replicated, but in a shrinking time frame. That could implicate it could introduce the idea perhaps that there's something similar that might happen here with a secondary push-up. I mean, this is a gigantic widening M-top. We already have evidence that this might be widening out. The push down went lower than that support did, the gap support on 578, and then it went higher. That's a widening spread, like almost immediately. Now, you might say, well, that happens all the time. Not really. Not the way that happened. Typically, if it does happen, you should take note of it, and it does happen. I'm not saying it never happens, but where this is happening, it's happening in the same range that the previous top happened, so it's especially noteworthy. What I noted is that if you look at where July 9th is, and you look at where that intersects that sign of weakness, it's like right around here at 570. I find that to be really curious. So if you look specifically, it's like right here, it's like 570 almost on the dot. That's extremely close to the 565 that we found ourselves at on April the 3rd, which was our Wednesday, April 2nd on that peak. Went all the way up to 567. So we're talking about a very, very, very similar, I guess you could say like target area, which I find to be extremely interesting. There's also this kind of rising support there from way back. I don't know if that means it's going to be at a reset point, but it would make sense to me if we're kind of introducing this idea that we're maybe doing this sort of repeat motion, that after this particular motion, we're going to skip sort of the extra fluff, go into this backup phase, hit 576, which we did, and then rise up into sort of a double topping action. That's really exactly what I have, and didn't really do that on purpose per se, but it's basically the exact same thing, that this is suggested as a possible double topping action. But then the resulting action would be some kind of hyperbolic, like really fast version of all of this. And honestly think that, yeah, that kind of makes sense that you might end up in a sort of I don't know, copy and paste, but something similar. I mean, we did do just an iteration of that upside rapidly. We may do another iteration of that downside rapidly. Now, does that mean I think it's going to go all the way back down to this bottom in that kind of a fast move? Probably not, but I'm being optimistic here when I say that, because in reality, this this widening here is already done. Like, it already hit that. There's nothing else to go for. Like, you break out based on levels now and on support. So if you look at creeks, that's already finished, and it never came back and checked it. Like, there was a widening build out here on the downtrend. There's no retest of it. And I mean, so like, somebody who's like super bearish, I don't think that's going to happen because, again, the news would be different this time. We've already processed it. So the idea of dropping all the way back to like 480s or something would seem like quite a bit. I wouldn't say it's impossible, depending on what is said and the outlook. But certainly, like, is it possible to make another massive move? Well, I mean, you tell me. The idea that tariffs are going to stay in place has largely been kind of debunked. Like, but we know that Trump's already said that, yeah, he's willing to keep them in place. So we know that there's been plenty of progress made in some of these talks, but we don't have a lot of information. So I don't think, do I think it would be like the same move here? Probably not. I think that's a bit unreasonable. But if you're looking at just creating a sell test that's fear-based, it's a definite possibility. I think what's more likely is you're going to kind of meet in the middle somewhere. There's a pretty sizable gap zone, and you can see the two high liquidity markers. One's at like 545, the other's down here at 513. This overall is like kind of a macro widening, and I haven't really messed with this very much, so you're going to have to forgive me for that. But I would suggest to you that probably somewhere in the middle, and I'm not drawing it correctly, I'm just kind of doodling it, trying to move through this pretty fast. Probably somewhere in the middle, there's a sort of a center to this wave expansion, and it probably hinges again around this March to April area, because that was like a halfway point of this spread. And there's probably another halfway point here. So we were able to identify those. It looks like it goes back to like that maybe. That would probably give you a good idea of where that check might be. This is not, sounds a little bit wishy-washy, like something that comes out of left field. Like, where's that coming from? But you got to remember, like, every structure is built on a top and a bottom, but then there's also a middle. And those tend to be the most, if I'm going to talk about, like, where do you find supports, that's definitely the most common place, right, is in dead center. Like somewhere halfway between top and bottom. Very simple, straightforward. And usually there's even two ranges that are kind of split, right, in tops and bottoms. We were just talking about that with the white coffee and stuff. It's not always the case that it's a perfect division. And sometimes, you know, if it's more bearish, you might have a stronger focus on bottoms. If it's more bullish, you might have a stronger focus on tops. So you're not spending very much time in this case right here. These are very, very like short-lived spikes down. They're not continuous at all. Like if I were looking at this big picture, you might say this looks bad, like, oh, the market's going to dump or something. Yeah, but there's not really a whole lot of evidence outside of what happened previously. This is a slower walk down. And see how that took that long. It took a year or whatever to walk it all the way down and do it in a slow way. When it does these kind of rapid fire drops, very rarely just kind of sits there because the move in is so volatile. The move out tends to be equally volatile. So if you're going to actually do some kind of major downside for a longer period of time, I think you need to spend more time kind of developing it, either developing it slowly down or developing a top. It's very unlikely it just kind of does a double dump down like super hardcore, but who knows? My point being is that this 50% range is probably going to be like your best bet. And if it makes sense with everything else going on, then I usually think that, yeah, that's probably the most likely. So I'm seeing a gap zone right here, kind of on this lower liquidity shelf. It makes sense to me that this might be a very important region. You can see this bounce has largely defined this push up. Did the same thing here, walked back through it, push up, walked back through it. Push up, we didn't really hit very much off of it, but you could see like coming back down, if you're going to try to find support and you were going to go low, that would make way more sense to come to like 555, maybe fill the gap region from right here, which again, that goes back to that April drop. I mean, it's very much like in line with what we're thinking is possible, and then really starting to build out. And you can see that builds out into August. That's really right where we think most of this price action changes direction anyways. So it would make sense to then have sort of an August build out. Typically the market goes into more correction territory. So, we're looking at longer term possibility of sideways here. This could end up becoming kind of a gigantic flag or something going into the new year. I'm not going to comment on that too much, just going to put it there for now. But yeah, for right now, I think that makes sense. So seeing this kind of continuity flow through all the tickers. I'm seeing a lot of potential, like they're all missing like a little bit of that upside move. They're all missing like that last push to sell off. And that's not going to be pleasant to hear, but I'm thinking it's fairly universal at this point. There's going to be exceptions to that probably, but a lot of these tickers look like they're pretty negative. And I know that anything can happen in the market. Things can change overnight. There's no telling. But my suggestion to you would be that by like next Monday or Tuesday, I think we're going to be peaking out, and I think that's going to be kind of the end of it. And then from about the 24th, you may go a little bit further into like the 30th, but I really think that by the 30th, you're going to be breaking down towards lows again. You're going to be doing a deeper retracement. Why not just drop right now, Booksy? Why even go back up? That's a good question. I think it boils down to like what were my previous expectations and why did I think they were good? Sometimes when you have and this, you've got like a bias, you kind of look at it, you read the chart and you say, oh, I think it's supposed to hit this target. When you get there, the question is always like, well, is it still going to hit this target? Like you got pretty close. It hit 604, it didn't hit 610. Why does it need to hit 610? Does it need to? Well, it doesn't need to go that high. And I actually wouldn't like it if it went above the previous top and then slipped really low again. If it's going to go above, just keep going, go up to like 650s or something. And we can make our pullbacks higher up. But for me, it's like, yeah, I think it would be best to take it easy for a minute and then do this pullback business or sideways business for the next several months while you're still within range, of this top, and really build out a new support again that's stronger before you go further. That to me makes a lot more sense if it's going to long-term continue a bullish run, maybe going into 2026, push to new highs. With that being said, there's not really any precedent that this has to push way higher, okay? It's really more about a combination of things and setups here that I think this is developing a bit of that bottoming motion, and it is going to go up high, and I don't think it's going to go to the moon. I've said this before, I'll say it again. The setup here, to me, reminds me a lot of stuff, but ultimately reminds me of a kind of a swing around setup where you're developing like a peak here. Again, didn't come too high, but it did advance above this top as if it's trying to turn around. And anytime you do that, I'm always thinking about that structure that we draw, because this to me is a really important structure to like kind of know, with the back of your hand. This tends to be like a cat ear structure. Somewhere in the middle here, there's a lot of nonsense. You're going to get those cat ears. I think we're getting them right now. And you're waiting to see again, is it going to drop low? In which case, the sign of weakness tends to be kind of the winner, where this comes down really low to wherever that is, which later tends to mean you're going to go down again. It could mean you have an upthrust here. That's not out of the question. What's maybe a little bit even more important, though, is that there's always some kind of a wave this direction. And if it's going to have a move up, whether it's bearish or bullish, 9 times out of 10, it's going to be in correlation with that move and then the initial drop in right here. And I mean that very seriously, like almost all the time, it's like right there. Now, sometimes it's a little bit off. Sometimes you might have it picked out a little wrong. But most of the time, it's like right here in combination with these things. You're going to have like this return. In this case, it looks like a breakdown. It looks like the cat ear up thrusted and then it's dumping. It hit a new low. I would be surprised if it just kind of held up and reversed. It'd be kind of like a double, almost like a triple reversal, like a 1-2 fake out, and then it goes. That's more of like a double 1, 2, then goes. Right now it looks like distribution, like up, up, drop, made a new low, hook, failed to advance right here. It looks like it's going to try to drop low. I don't see that as a big problem because, again, I'm looking at this like big picture, like, yeah, but there's not really much here that it's going to be problematic. In the end, it's going to go down. Maybe it's going to go down pretty low here. Could look kind of the opposite of what I drew at first, where you have some serious build down low. That's fine. I actually don't see that as a problem. May even use this as a bit of a wave cross, and then I still think genuinely that could mean that Monday is still up, because if it were to do that, and I know 2 different paths here, right? But this one didn't hold just yet, so I don't think it's the best one right now. Again, unless it's some kind of like double fake out, which is sort of strange. I mean, it happens. This is not the most common thing. If this happened, I probably wouldn't be bearish going into Monday. I'd be pretty bullish. If Friday we're right here chilling out. Because, again, the main point of this waveform is not necessarily to continue breaking down all the time. Sometimes it is and sometimes it isn't. But the big picture would be that, yeah, we didn't actually come back up and check this guy. And I look at that kind of stuff and I'm like, it's a mixed bag. There's obviously ways to kind of fudge your lines and make it do what you want it to do. In the end, I'm probably going to look backwards and suggest maybe this one as a stronger breakdown target as opposed to this one. So instead, looking at that drop ledge and like, where did that drop off right here? But again, this is a pretty easy to read chart. Like almost always, even if it's going to sell off again, this will have some kind of a bottom and come back up, even if it's going to sell down again. If it continues, it'll kind of stop here and push above, and then it'll continue, and you usually get like a second wave. So I'm looking at it and I'm like, yeah, right now that doesn't seem very likely. That would be like today or tomorrow or Friday, like right here. That's pretty darn soon. That intersection is really, really, really close. But if this is brought down a bit to either that hook level that becomes Monday or the drop level, which is very low, again, I would probably use this one. It's hard to say. This one's really low. That would be way over here on like Thursday, the 28th. I'm thinking this is the most likely as a secondary one. This goes up to Tuesday. So you really only have like a couple different options here of like a Monday, Tuesday type move. Everything else kind of fans between them. Yeah. So from here to here, from now until Tuesday, it seems pretty likely that you're going to form some kind of a bottom and have a rebound. Again, this would have to come pretty far up here in order to rebound. You really have to jump 600, 601. And then you'd be in a good place, I think, to move to the upside. And ultimately, this is why I would watch this level. So if it takes a little longer, we might be a little bit sad about it at first, especially if you have contracts that are ending like this week or something. You might be like, well, this was garbage week for me. I get that. I'm not saying that it would be fun for anybody. But ultimately, like next week could then be potentially very, very explosive. I mean, you could have a move that takes you all the way up to 608 Monday into Tuesday, 610 even. What's going to cause it to happen? I don't know. And I don't really care. But my suggestion to you is that makes a lot of sense. And if you look at the measurements on some of these others, that does work. It really looks like a Monday, Tuesday kind of thing. And then you'd be probably in breakdown mode by Friday into Monday, which again also makes sense here on SPY. So Friday is... So this is Monday, Tuesday, and then Friday the 27th. It may be a little bit longer than this on SPY then. I've got it kind of going up and then right back down. But where would the breakdown be, right? That's the question to ask. I guess it would be over here. So you'd have a 1, 2, and then a 3, 4, like a bigger 3, 4 that goes up. Kind of a squeezing motion going into Wednesday. Then some kind of a topping action going into Friday. And then Monday would likely be like a hook. So whatever happens, you're going to top off here and then probably have some extra moves going into Friday, but you're going to force it into like a breakdown zone. And that would be the end of that. I mean, I think at that point you're looking at some pretty severe ongoing downside. That's very likely to me. So I'm still going to kind of hang my gloves on this idea that may be a little bit controversial based on the charting, not necessarily based on personal views. You may love the idea of it going up, but I'm going to say based on the chart, it's still a little contrary. It definitely is. And I am playing it like that. You know, I've got call options going into next week and stuff. I'm not shying away from saying that because I'm looking at this as like, this is a pretty strong possibility. And I've thought that it may even happen this week. I'm not sure. I think at the beginning of the week, Monday or Tuesday, I said, I don't think I streamed Monday. I think I was saying that like, well, it was last week then. I was saying like probably by Tuesday, Wednesday, which when the Fed meeting is. And then I said something like, oh, but I guess it could be Thursday, Friday, not thinking about Juneteenth holiday. So I wasn't thinking about not having the market open tomorrow. But yeah, this is certainly one that makes sense to me. So I'm looking at this as a strong possibility, not a guarantee, but a strong possibility because I think that we're going to kind of overextend and then come back low. This is going to be the big kind of whip around motion that we need. And it's probably going to drive us down. I'm not a huge fan of using the 50-50 here necessarily, but this could end up being like the bigger widening. And I didn't look at it like that earlier, but now I am, like this. Especially if it comes down, that could be a good sign. But this is certainly a possibility. So if that's the case, and we'll see how high it goes, we may end up being back, I may go pretty high, but we may end up being back to... let's see where the middle is. Yeah, right there at 601. So that's the right spread. I mean, that's a really easy to read. So it'd be some kind of like, kind of fake out good news move, and then you would die going into, and kind of dive bomb going into the following week. That following week would start off probably really red if it did that going into Friday. And it'd be like a turnaround Tuesday kind of moment, where it has like a rebound into the end of the week, sort of chops, or midweek, come back down again. Yeah, I don't know. At that point, we're getting really close, but if it drops again, I could see it going down by the 9th. It's not that unreasonable. Actually, it kind of puts you right where you need to be again. Maybe not like right on the dot where we were back in April, but that's really close. I mean, you're talking about a stone's throw away. So could it hold up better? I mean, it could. I'm not trying to read tea leaves here. I'm just saying like I think there's going to be an extended move up. I'm watching these jumps. There's a section right here I'm looking at. Once you start seeing the market kind of top off, I'm going to be pretty conservative about it because I don't think it's going to keep going. I think this is just going to be distribution type motion. And again, looking at it like Monday, Tuesday is probably the latest I would hold anything. I did buy back into Starbucks. I don't know what happened today. Yeah, I went back down. That's good. That's fine. I wouldn't even care if it came down again. This is again is a little bit of a widening motion. I think you're going to get that 50-50 up across this, perhaps to distribute. I'm not really looking for this to go to the moon right just yet. I think if at most we might see it kind of come up again. Again, Monday, Tuesday. We'll see. Maybe up to here. Originally, I thought that this was going to probably run back up really far to near 100. I would be very surprised if it got up to 100 at this point. There was a lot of reasons for that, but I'm kind of the mindset that it may not get there now. I'm thinking that we might just kind of top off and then head back down into the tariff thing. Seems likely. Yeah. And AMC's doing that thing. I mean, this is kind of what you want to see. When you get to the end of these drop downs, you really want to see a change of character. It's doing the top motion now. It bounced. You want to see it try to dip but fail. And really what's best is to see it dip onto the outside of the creek. So I think the creek's in the right place. It's got the bar coding look. It's got the double top look. It's struggling right here. That looks like a second cat ear, but it also looks like ear one. You know, like the other one hasn't been made yet. These are pretty easy to read on the RSI. You can see the move up, up, and then low, up, and you should have another up. So if it makes that cross there, I think it'll be okay. And I don't really even care. It looks like Friday morning. I don't really even care if it comes down again. I just want to see if it holds up here. And if it holds up here, or if it does a quick dip and then comes back above, you'd be in really good shape right there to move. And I think you're going to see a pretty explosive move. So Friday could be a very green day. Could be a nothing day. Don't get me wrong. In terms of red, I'm not sure yet. I guess if SPY and the market kind of takes this south and heads low into Friday, then yeah. If that happens, I've already said it. I said $3 was likely. I said 296. I still think that 296 area is possible. I believe this is like an 854 retracement at this point. I'm going to double check. But the 854 is, I think, right at 3. Yeah, I mean, it's like right on it right now. That's the 854. It's the top of this bar. So, yeah, we've already got it on the chart. I probably had that on purpose. I'm not sure. So, yeah, staying right here would be definitely ideal if it can hold above the 854. I think if it doesn't, then I have no idea. I'm not going to look at fibs. I'm just going to suggest the 296 was one I triangulated. I think it's a good target. So that's one I would look at. This would be a good setup for Friday. Anything else may lead to more downside. And then again, I'd be looking at 296. Nothing really to worry about, just something to watch. Same thing with GameStop. It really already made an SOS of sorts. It kind of pushed over the top here. I'm concerned it didn't close beneath it, but directionally it's just kind of heading up into a corner here. We need to see that form a almost like a cup and handle type deal. Like this would have to rebound higher and then make a like higher low, and going into Friday kind of push above. That could yield some pretty strong movement, as you can see, especially if it breaks right here. And that's what it looks like. It really looks like this is pinpointing quite specifically Monday. I don't know if you can see that, but that intersection is right on Friday into Monday. That's like the end of the day, which it happens all the time. So it looks like they're going to kind of pop it into a corner. Honestly, if it were just GME and not AMC, I would actually suggest that downside here would probably be to our benefit to go ahead and get some kind of a final like retracement would probably be really positive for GME. It doesn't necessarily need a spring, but I'm not really sure about that. But I'm like, that wouldn't be bad. I wouldn't hate that. To me, that would look pretty strong if it dipped low, maybe between these two supports, just to test the waters, and then it rebounds Monday. I think you get a pretty big pop. And going forward, I'm not 100% positive about any particular perfect setup here, but I'm pretty sure it's going to come back to 26 and test it very quickly. That's obviously right around the corner. And then looking a little bit higher than that, you can see this pink line coming down. That's roughly where that creek is. I think that's going to be where it goes. That's 26.95. It's kind of right in between the gap here. I think that's where it'll probably make a decision going into to Wednesday. So again, you're looking at a fairly sizable move. That's a 20% move on GME. That's a big run up. Then if it goes down again, you're probably like, well, that doesn't look good, right? Well, I don't know. GME ran ahead of the market last time. It did this correction thing before, but in this case, we're already low, and we're not even to the April, not April, but the July deadline. So you've still got like 2 weeks of, possibly coming down. Who knows? I'm not going to overcomplicate it at that point, but I think, sure, could this come down and have some sideways action and still like make higher lows before then? Yeah, I mean, it's possible we see another sell down. It'd be strange. You might be thinking like, well, that just looks really bad. And it kind of does. But I think that you would have to consider that it's probable that we're going to be right around or just underneath that 26. Because on the big picture, that's where you got to go, you know, to break out or to die. Either way, if you're going to do a nosedive or if you're going to break out, you're going to be at that level. And because of how close we are to that July deadline, I just can't imagine why, unless, again, it's running ahead slightly of everything because it already made like a corrective move, and it doesn't need to make any more big corrective moves. I just can't imagine why you would take off here. Like, to me, this is exactly where you'd want to keep it, right in this little pocket here, in this region going into that meeting or that deadline on the 9th. And yeah, if it goes down from there, it goes down from there, you know, you're looking at coming down to new lows. But so far, it hasn't made that lower low. So someone had asked me what I thought about that, and I didn't really give a great answer. But my main thought is that at this point, I do think it's likely we'll try to get back to near 32. If you're somebody that was kind of stuck in a bad position and you're wondering about that, I don't think it's very likely it gets left behind. There was no back test on it when we dropped. It's a very odd move to make. And then the buy-in for it does get you to a possibility of like recapturing. So maybe it goes up there, you know, and then recapturing the 26 level. And it gives you space. So even if it moved up to the 9th, maybe it pumps up into 32 on the 9th. If the rest of the market or AMC or whatever is in a breakdown mode at that point for whatever the news may be, sure, like GME might have some reaction to that. And it makes sense to then come back. I know it seems silly because you're like, how many times do we go back and test 24 or 26? Well, frankly, because you made this move down, at this point, it's kind of necessary if you're going to go up again. It may be a bit difficult to see on the chart because it's too many lines. Maybe difficult to see it, but it probably very necessary. I'm just going to delete those to see this reaction. Yeah, I don't know, man. That trajectory, I think this is going to end up widening. I'm not sure why, but I'd be surprised if it didn't. But I think what you're going to see is that this still has to now jump above and come back and hold support because it failed. When you drop back through a creek, you've now, unfortunately, kind of deemed that it's not a support anymore. Well, now that means it's a resistance. So you're going to find its resistance probably. Maybe not the strongest resistance, but it's going to be a resistance. It's like what happened here. It's like pushes up and jumps over. Oh, it'll never come back down. Well, it did, right? You know, it did. It came back really low and very close to where that is, unfortunately. Because it goes to where is most likely going to find where those buyers are going to step back in. Here you've got a similar problem. I'm not positive what happens here will happen like this. You know, maybe it has the breakout earlier than the rest of the market and it's already going up. Don't really care. But I would say that wave now makes sense and it would have to change. You'd have to have like a new, I don't know what the best word is, but you're going to have to jump this creek. That's why I did that. I can't remember why I put that where I put that. I think you're very likely going to have to retest. Again, whatever high is made here, if it pops Monday, Tuesday, that area, there will be a generated new support and resistance right there, like this area. That makes sense. So you'll come back down. And then that wave cross, that retest on that creek, could it prove to be bullish? Yeah. I mean, that's where we could have the conversations of like hopium, right? It's like if it does this move back up and it holds above here, could it stay bullish? Yes, it could, for sure. It's a bit wonky looking. It looks like a repeat of what happened before, but smaller, but it is, you know. And if you're looking for that and you're saying, well, where's the change of character? This is it, right? If this is where you get this kind of push down and it doesn't go through maybe that creek, let's say it does go back low, but it doesn't go through the creek, I could see that coming all the way back down to like near the bottom, almost like a double bottom, going into late July. And it would look bad, except that it did technically hold above this creek that it lost. So now it looks stronger. And then you kind of do the same thing all over again. It's a bit odd, but sure. It's a holding pattern going into August. And at this point, if this were to occur, granted, I'm just doodling here, but if this were to occur and you did get a push up here, just like we're thinking with AMC, we're suggesting that this might happen to some degree. It could happen now, it could happen a couple weeks from now, going into the 9th. I think you're likely going to see something similar where you've got that advancement and then this trend generates like a new creek that would then be jumped later in August. Certainly could present itself as an alternative LPS scenario to this really negative one where it really just kind of tanks below. And that's more in line with the idea that this ends up distributing, and I don't know where it would be exactly. My guess is around 28 to 32, and it would just sell through and not hold. I think if it breaks that creek again, it's going to be bad. And we haven't even gotten above it yet, but I'm thinking it will, probably. Passed above it here, I think you're probably going to do it again. But if it dropped through it again, I would think, yeah, it's probably going to crap. You're going to crap out and go really low at that point. And that's the scenario where, again, you kind of fail to make certain checks, and this just becomes a huge, like, kind of cat ear motion down, like a wave down, up, down. It's the same thing we were talking about back here when you had that possibility of downside here. So I get the same exact thing. You need to see it kind of not make that decision and continually choose up and break out. So right now, kind of a nothing day. Made a new high, like a new push here, made a new low here. It did a flush. And it actually looks like it flushed. This is kind of odd. I'm going to go over and check out this one that was been requested, but ONCO. But this is interesting because it did break the creek here and drop below the floor, but it didn't actually push over the high, which is kind of curious. I mean, at glance, it looks bearish. It looks like a drop with a hook, but we'd have to see it. We're going to have to see what happens. It's not going to happen today. Like, we'd have to see some kind of breakdown right here, and it's just not going to happen today. It's really unlikely. Frankly, I think they're leaving it open on purpose and kind of just keeping it at 0 today. This looks like a double up thrust, but then this looks like a double down thrust. Like it is doing kind of a double reversal. So now it has to make a decision. It's hung up right now underneath the ice, which is what makes it look kind of bearish to me. Bigger ice it does, but lower one it doesn't. So then an S curve here doesn't actually go that low. It only goes down to there. It's really like not a lot. Let's do this instead. Let's measure, because I think it's offset. Yeah, that only looks like it would go down to like 595. I wonder if it holds on this. Yeah, I wonder. I wonder if it holds somehow. I guess we'll have to wait till Friday, but I wonder if it holds through this on Friday. Like this, so it creates a kind of a rebound move and then holds up. That'd be interesting. Whatever. This is speculation anyways. Maybe the bulls really don't allow it to drop, because you could use the middle line here and that could be the support that you need. It's not aiming that low. That's why I'm finding it to be kind of curious. Like, you know, it didn't really drop that far. Seems right. So something like this. Well, that's easy enough for downside. Upside would be over here. Just jumping over the creek, that's easier. It's a lot simpler. Okay. No, he was talking about Powell, his responses. I mean, he said the same thing he always says, so I don't really want to do a lot of commentary on it. Yeah, that's a pretty strong divergence on the bottom. So the last time this was like this, you had this motion down. Actually, this was divergent for a really long time. This is really strange. I wonder if it's because of that. It was divergent from like back here down. It's kind of ugly, huh? It's a possible another one right here, but the way this is traded, it's a very odd looking chart. See, that's weird. That's actually not, the divergence goes to here. Well, I'll say this. It was like actually that might be the case then, because there's a similar motion here. See that S curve down? That's like the selling climax. Once the selling climax happens, there's a kind of walkthrough, and once it gets above there, you get this wave across, and doesn't ultimately start switching direction until the bottom. Here. It's very odd. But now you have like kind of an equal argument. It's literally the same thing, isn't it? Got a very similar motion. Where it's starting to land on top of it. Hey, will you spray if it's growling? Well, here's what I would say is if you look at these major moves, these guys, they come after, I'm on the 4-hour, they come after building a support level kind of around the bottom, and it's typically after like a big move and further sell off. I mean, these are still selling off while this is creating like a support. This is a very weak looking chart in terms of like how that strength index didn't really matter. So the same thing here. It's like it kept selling down. So I'm a little curious as to what would make this look attractive aside from volume, maybe. Oh, the split. Goodness gracious. So this had a split and it did go really far after. Well, it went back up to recheck liquidity and then it dropped like crazy far. I could see why you would think that then, because of the split, that it might come back up here and like retest the liquidity. There's a gap too right up there at like 630. Maybe. It's kind of ugly, but actually it's really actually very clean. I know that sounds like backwards, but it's like at first glance this looks really wrong. Like it looks like something that's hard to read. But then you stare at it and you're like, no, that's actually right where it should be. Because it did the drop ledge right here, and that's right where the triangulation always is. When you do that walk down, I mean, it's like perfect. Weirdly, because it made this really strong support and then this really strong rejection. So you have this really, really strong support right here. And then the RSI and everything just makes it confusing. So I'll tell you what, I'm not going to use the RSI really. I'm going to use some more controversial methods, I guess you could say. Right, so you're kind of in a similar situation. You've got a ledge. You just dumped off the face of the earth right here. There's a kind of a creek coming down. I mean, I use it like a trend because it was sort of there. And I'm not sure exactly where it is, but it's kind of there. And it goes back pretty far. It's in the vicinity of what's going on now, but there's also like EMAs and stuff you could use if you don't like that. I didn't use the high point here. I just kind of used these 2 points. So the lower ones. That's a possible triangulation spot. So what we don't have is we don't have any kind of uptrend except for this one. And then there might be one here, but I'm guessing that it's already been fulfilled with that. So that's just like this layup and rejection. Yeah, I think this one's kind of done. I don't think it's going to use that again for a while. So I don't think it's going to 3x. I don't know if that was the comment you made, but this is kind of a weird situation. There is divergence on the bottoms right now, but it's nothing that a good shakeout couldn't kind of eradicate or make very quick work of. Just because last time it had a reaction doesn't mean it has to happen this time. So there's also that. July 9th, 250. There's also possibility it's an inverted interception, but no, we could look at this as a, yeah, there it is. So there's the intersection right there. It's the same marker. So it seems very likely that this S curve is attempting to get down to 260. Like very likely. This is you're anchoring all the volume here. You're loading up on shorts and you're using these up thrusts to kind of generate. It's really like buy-in. If you flip the chart and you look at it like this, you'd be saying, yeah, that's possible. It's going to go up again here. So I don't think it's very likely that this is going to 3x. But what I would say is that it's possible. I'm going to drop this one down. You can see those intersections are kind of at odds with each other. That's pretty normal. It's possible we're kind of going into a sideways action because the market doesn't really know exactly what it wants just yet. So I do think this 405 is a good place. It might make sense to have a like a quick jump, just like everything else we're talking about, and then start down. You know, something like this. I don't know exactly how far it goes. There's two spots, I guess, I would consider likely. One would be the this guy, and then the other would be here, all the way back to that gap fill, or near it. Yeah, I mean, this S curve, just to me, it just doesn't look done. So if it is shallow, I mean, if it breaks out here, yeah, it's going to go pretty far. But that's really hard to know when you're at $4 if it's going to break. How do you know if it's going to break out at 6? You just don't. I don't think it's done. This looks like a situation where it's close, but it hasn't quite made the moves. Yeah, it's going to make, I think it is going to make one more right here going into Tuesday. Kind of like everything else. I think you're going to get a potential pop here. And then it has to make a decision, you know, around this anchor point. But I'm thinking that that's a 50% move. So what we could do is, and I'm not going to keep this on the chart. What we could do is, yeah, it could be pretty steep. These have pretty huge pops. Again, that's not 3x or something. That's a big move, though. I mean, it's not small. It's a 50%, 30 to 50% move. But July 23rd. That's like doubling up too, weirdly enough. Isn't that weird? It's like twice the amount. Kind of already know the answer to this, but should be back to here. There it is. It's like there should be a creek there. There's definitely a creek there. Very strong intersection in this region. That might be where it finally like makes the jump over the, I don't know exactly what that's going to look like, but that might be finally where it makes the jump over this trend if it's going to go up. And it's going to be a cross because that's where the cross is, so. You know, weirdly, if that happens, it's really close. That could be kind of the end of it. August 11th. I wonder if it's just going to build a range right here. Not sure it would go any further. Like typically this does go up into a like if there's a wave and it doesn't advance here, it would go up in like a parallel fashion to this point, and then it would drop down again, because it would start generating like an M-shaped bottom this direction and go sideways. So that might be a possibility that this is like an auto reaction and a top, and you end up coming back down and creating a kind of secondary floor. It's going to go again. And frankly, at that point, it's a big question mark. I don't know if it does go again, but if you're going to break out, that's probably where I do it. If you're not going to break out, you're going to have like a fake out move. You might not come all the way down again. You may like have a second move up of sorts. That just goes into distribution mode kind of for the rest of the year. I mean, there's really no telling. I don't want to get that far into it, but that's way too far off. So you have massive support. That's a really clean wave too. So it might be something to that. There might be a bigger wave to look at. That one's really solid. Like super easy rotation. That's the same timing too. Well, I mean, from a rotational standpoint, that would just suggest to me that this is going to drop. Like down to this point, way down here. Yeah, right there. Wow. It's like perfect. So this is a middle of two waves, wave one, wave two, but two is like, in this case, I don't know, man. It may not, that may be hit. And like I said, last time they had it went up again, but then it sold right back down really hard. So that's a pretty bearish scenario. So if that happens, maybe this comes up and it actually stays up pretty elevated until the 9th. And then it just starts selling down really hard. So it consolidates here and then drops through the floor again on the 9th. It just goes all the way down. Starts a brand new sell-off. Of course, it's like $1. It's right on $1. You can't make the math up, guys. I mean, I could try as hard as I could. I would never be able to design it perfectly like this. It's already there. So, yeah, I'm against this being like a 3x kind of chart. I don't see it like that. It seems very likely this is going to come up. Oh yeah, nice. Yeah, I got out of that right at right like this afternoon. Basically, I don't know where it was, but that one's done. Yeah, this seems pretty likely. No final thoughts. It dropped. I don't really care. It hasn't, like, this doesn't surprise me because when it was generating this, see how it pushed that low? So like right now, I'm not particularly surprised that it didn't advance here. This looked like a 4-top kind of cat ear, and you can see it a little bit earlier than expected, but what really matters is what happens on the next one. And that's probably not going to be till Friday. Maybe some after hours action, but these are just repeated sell-offs. You can see the M shape here on the big picture. This is as clear as iterations get. I marked it off even. Drop ledge, drop ledge, drop ledge. They're just perfect like 50-50s up. This is the first one, then the second one, and then this is like a third. So could it go lower Friday? Yeah. That's what I was saying. If GME goes down, I could see that AMC, and if the market on the whole kind of slumps a bit Friday. I don't know what would cause a big markup on, Monday. And frankly, is it possible that this still goes down in an S curve and drops low? Yeah. It's not super usual to have this kind of falling wedge action where the volume's kind of slumping, result in some kind of a final push, but it does happens up and down. It just looks like an S curve in the end. But yeah, this doesn't surprise me there that much. What I really want to see is if this makes a higher high. So if it doesn't, not characterized and changed yet, this could end up becoming quite nasty. Thus far, nothing here looks particularly parabolic. So I can't say that. Could it get that way? I guess. If this did a little M shape here and dropped again, I mean, we could start going parabolic, but it hasn't thus far done that. It's been pretty rigid. This is a really simple structure. So if it did that, I think it'd be more likely it's just doing it for a final drop. You're going to get some kind of like a final, like a really quick final drop, and then it reverses the other way kind of thing. That would be more likely. Just a sharp reversal. Otherwise, a change of character would just be a not making another low. So like doing another M shape here, and then instead of dropping, it goes out. And it crosses up and out. And then that starts the chain reaction. So that's all there is to it. I'm not particularly concerned if it drops down here. Not yet. I still think we're going to react to 350. Yeah, if nothing else. So. This to me is a little more concerning than like AMC, I don't like the elevated sits. I don't really like that. It gives a lot of room for downside. Like just not coming back down to, I don't know, AMC's just falling, so there's that. But just not coming down just doesn't feel good. This is popping a little bit in after hours, like 50 cents, but it's consolidating. It hasn't, you can see like that consolidation around the bottom. It's really not made a decision. Looking for Onco to run from 10 to 16. Yeah, I don't see it. The way that happens, the way forward here is that even if this does work out, this still has to come up. I think it would have to come down and make a spring. So the way that happens is like you basically have a bounce here because it already went to lows, right? It pushed down to new lows, but it would generate like a new push out and then a spring. So you would still have like another bottom, in my opinion. So if this came up and consolidated, that to me is not enough. Like you'd still have to come down again, and it could be over here and go down into a spring into like July and then build back out. That could be strong. I don't see a phase B bottom though. That's what I'm trying to say. This doesn't look like it to me. It just looks like the walk down isn't complete. And then it goes really low at like 250. It's the same kind of chart I already have. So I just can't imagine it just going up from here. And like I said, if it did do that, it'd have to be here. Like you'd have to have this really huge move above 7 to 9. And there's just, that's so far away, That doesn't mean this is a bad trade right now. If you're willing to trade shares, I think it's possibly a good trade. I would caution that this still has the effect of potentially like being a 1-2 cat ear where you haven't actually made the last leg down. You can see that motion here. So there's certainly a possibility that this still has like a little up thrust and then goes low before really reacting. And I think that's important to note. There's just a lot of uncertainty here. I personally don't see this as a guarantee. This has not resulted in immediate upside. Even when they made bottoms, which has happened, you get these big moves. They're not 4x moves. They just pop and then drop again. I don't know what to tell you. Like, if there's something here to look at, it'd be this wave. And I can't see how you get past. So your 10 to 16 mark maybe works, but I'm not seeing it like right now. You have to jump this creek. Like, what's going to propel that forward? Volume and setup is a little better than this one, but it does look stronger. I mean, I think he's holding up better. But the split doesn't make me feel good. And all the measurements to the downside are there. They don't have to hit. But they're definitely there, man. Like 262 and this dollar measurement, it's not avoidable. I'm not going to sugarcoat it. It's just there. So I could certainly see this having like a hook and then going really low. And frankly, like looking at the big picture, it's just a continuation of like a macro S curve. If it's going to make a bottom, I will say this. If it's going to make a bottom and have a big reaction, it's probably going to be in this pocket right here. Measurement-wise, it's coming to sort of the end of the rope, I suppose. There would be a reaction here somewhere, potentially. But I just don't see why it would go anywhere except to $1. Even just looking at this super straightforward, like that low, that low, that low. I mean, does it look like it's going to suddenly invert? No, I mean, it just dropped, just did a cat ear drop, and it's got a hook maybe in it, but then what? It looks like it would be heading back down to this really low RSI bit going into this region. So I'm happy to be wrong. I'm not always right. Sometimes I don't see it all, missing something really important, but I'd probably be looking at this dude. Yeah, as like kind of a final trajectory guide, perhaps. On these EMAs, I could see why that would come down again to 21 and just come back and retest it. It's a huge vacancy here. All right, I'm done. I got to go. I hope you guys have a good one. Talk to you later.